Good morning, traders and investors. Roger Scott here, senior strategist for The Trading Pub. Today's Tuesday. It's November 28th. Don't ask me where this month is going. Don't even ask me where this year is going. I'm stuck in February of last year. No joke. It's about 7:42 in the morning. The market's not going to gear up to open up for about an hour and 48 minutes or something like that. Not for a while. I'm here a little bit earlier. Couldn't sleep. A little cold here. It's 65 inside my house, and I still haven't turned the heater on. I'm taking this cold spell for what it's worth. It's been literally 72 to 75 in my house for the last 10 months straight. So I'm enjoying this cool wave, even though I'm not a big fan of cold weather, between you and I. By the way, before I get too deep into this video, which I tend to do, make sure to subscribe to our YouTube channel. Just go to YouTube, go to Roger-Scott in the search box, and you'll see us there. Just subscribe to it, post link, click the link button, click the bell button, click whatever you have to do to subscribe to that channel, and you'll be notified when these videos are posted immediately. Number two, subscribe to our Telegram channel. I post trades there all day long. I give hot red meat there. Go to rogerscott.com/Telegram. You could find all of this below the video, and make sure to join me in my VIP room at noon today. How can you miss that? It doesn't cost anything. You really are missing out if you don't show up there. And again, all the links are below this video. Now, let's get into all the good stuff. So, the Nasdaq is down about 20 points. The Dow is down about 2 points. Russell's flat. Very little trading action overnight. Not a lot of unforeseeability right now as we head back into the season. Now, interestingly, I wanted to show you this. This is the S&P 500 yesterday. The average volume, just so you could see here, the average volume, let me just delete this here. The average volume is around 80 million, 85 million. We were at 50 million yesterday, like 60% of average volume. Just to give you some perspective, on Friday, which was a half holiday day, it was probably the slowest trading day of the year. It was 31 million. We were at 50 million. I'm hoping that today we can get to 70, 75 million. I think a lot more folks are going to be back today. But again, until we get back to the reasonable volume, you're not going to see a lot of follow-through. And without a lot of follow-through, we're seeing a lot of random trading action. And when we see a lot of random trading action, it makes it very difficult to gauge the market effectively, because what you're staring is a bunch of randomness. Now, when you combine that with the fact that in November, the stock market gained about 10%, it puts even a bigger pickle into all of this. So the question is, are we going to come off for a few days, sit tight, and then come back up, or are we going to curl back down? I personally don't think we're going to go down much further, maybe a little further, maybe down to this gap, which is a little bit further, but not all the way down here, simply because we've gained so much. But we're still in a bullish cycle, and earnings are behind us, and we're still in a bullish cycle, and the Fed's not going to change anything. And again, usually the last month and a half, 2 months of the year are fairly bullish. So we may just see this come off a little bit more, shake out the weak hands, and start coming back up. But I wouldn't make too much out of what's happening right now. I wouldn't paint a picture for myself, because we are still, look at this. This is pathetic. Ever since this whole thing has low volume. So we got to be really, really careful around these parts here. Remember, we're above the 100-day, the 50-day, the 200-day moving average. I know the 50-day is below the 100, but whatever. The point is, we're still up here, and we got to be careful. We got to be really, really careful. And if you look at other indices, you will see exactly the same thing pretty much. Also, very, very little follow-through here on volume. Volume just getting lower and lower already for a few weeks. Holiday coming, it's got to start coming back up. But notice, not a lot of trading action, just very subdued trading action. So the question is, are we going to come back, or are we just going to consolidate and go higher? One way or the other, the market needs to consolidate, because after seeing a run-up like this, even a run-up like this, the market needs to have a couple of days to consolidate and recalibrate itself. Bond market gives the stock market a lot of its juice. Yesterday, we were opening below the range, but we bolted higher, which is good for stocks. And now we're once again above this range. This is telling us that the market believes. Now, what the market believes and what the Fed believes are two different things. But what this is telling us is that the market believes that we're going to see lower interest rates in not so distant future. Now, I don't personally I don't personally believe that. I think rates are going to stay here a lot longer and be more stubborn. But this long-term bond is pricing in the fact that we're going to see a rate cut as early as March. And the odds of that are about 20-30%. I think those odds are going to be going lower, not higher. But that's just my personal opinion. But we got to follow the trend. And the trend right now is telling us that bonds look good. And this is taking pressure off of the stock market. Now, let's just look at QQQ before we move on to the news and sectors. Notice QQQ still holding up pretty well, just like the S&P. I think actually the S&P is holding on the worst out of all of them. Let's take a look. Yeah, just a little worse because it's got energy pulling it down. It's got some sectors pulling it down, and I'll talk about that in a minute as well. Now, let's talk about global economy and what we can expect. So yesterday we had new home sales. Sales are down, but permits are up, which is exactly what we saw before. That's mixed news. That's not that bad because if permits are up, that means they're looking forward to interest rates peaking or going down. The fact that home sales are stubborn right now, it's also the end of the year. New home sales usually don't do well year end. They usually do well first half of the year because people buy new homes because they want to have addresses for school before the new season starts. So home sales gear up during the March through June period, even March through July period, not the last end of the year. That's not the time for home. But the fact that permits are going up is telling us that investors do believe that interest rates are going to peak out. Otherwise, permits wouldn't be going up. They would be going down as well. Today, we've got consumer confidence at 10 a.m., the manufacturing index at 10, which means you don't want to make any big bets before 10 a.m., maybe even 10:15, 10:20. Don't think trading early catches the worm. No, you don't. You get mixed up in a bunch of algo nonsense. Tomorrow, we've got GDP. We've got personal income, which is going to tell us a lot about the core inflationary data that the Fed is looking at. We also have ISM manufacturing on Friday and OPEC meeting tomorrow. Speaking of OPEC, I'm looking at the energy market, and we're just sitting here at the 200-day moving average. And the war in the Middle East is not having any major impact on the energy market anymore. But the fact that we're still sitting around the 200-day moving average may give us a little bit of a juice of a bump up. And it looks like energies may be a little bit oversold for the time being, especially in light of the current economic condition. Now, let's talk a little bit about global economy and what we can expect. So, and I kind of give you a nice little review of what we discussed too. So we're waiting for economic data and speeches from the Fed. There's going to be plenty of them this week. Shopify, remember we were long Shopify? They did really well. They were upgraded. They had good earnings. The stock is up 4%, which is great. Had great Fourth of July. Had great holiday Black Friday sales, from what I understand, which is good for Shopify. New home sales fell, but again, permits stronger than expected. You see that? That's important. That's really important because the market always discounts what's known. There is now a 23% chance, based on the bond market's value, that the Fed is going to cut rates in March. I don't see that happening at all. I think this number is going to go down, and I think it's going to take the bond market with it. We've got earnings this week. We've got Intuit. We've got Workday. We got CrowdStrike. We got Splunk. You got Hewlett-Packard. Now, these are not Class A FANG stocks, but I'll tell you, a lot of day traders trade CrowdStrike, Intuit, Workday, Splunk. Remember Splunk? Don't get splunked. And HPE. So keep an eye on the market, but especially the technology and communication and consumer discretionary, because that's where these are. These are mostly communication and tech stocks, so keep an eye on that. But they're not chip stocks, and chip stocks have been holding up better than most. Consumer confidence comes out today at 10 o'clock. U.S. Richmond Manufacturing Index comes out. You got the Peanut Gallery, Goolsby, Waller, and Bowman all speaking. Europe not giving us any tailwind right now at all. As they're digesting European central banks. Policymakers cautiously awaiting release of inflation numbers and Fed data this week, which is going to be the core number. China closed slightly higher, giving us a little tailwind, struggling for clear direction. Welcome to my club. As market participants anticipate Chinese manufacturing data, healthcare and auto stocks gain ground. Japan, no tailwind, no soup for us from Japan. The yen extended its advance in the wake of treasuries. Data showed on Tuesday the key measures of Japan's trend inflation surged 2.2%, reaching a new record high and indicating a broadening of price pressure, thereby strengthening the case of central banks scaling its massive monetary stimulus. That would be really good for Japan. They're getting way too much stimulus. It's diluting their yen. And Boeing gained a little bit. Zscaler plunged. One of the earnings that I talked about already came out. So what are we watching today? Well, let's see where the market is. 6-week average on the trends is telling us that home builders, technology, semiconductors, retail, QQQ, that's the last 6 weeks. That's very speculative. That's bullish. Last 3 weeks, semiconductors, technology, home builders, QQQ, same thing. No major differences here. Clearly, blue chips underperforming. Let's look at it in the last 5 days. Ooh, healthcare. NVO, the stock that we have, healthcare has been the leader. Real estate, Dow Jones, consumer staples, materials. Do you see what's happening? Blue chips are starting to fight again, and they're starting to overcome technology. This is what happens when you see market give too much too fast, and investors are looking for profit taking, or if you're short, loss taking. But there's clearly a clear shift to blue chips right now. This is not a coincidence. Healthcare, real estate, Dow Jones, consumer staples, basic materials, they are all leading in the last 5 days. So we can't assume this is going to stop. Matter of fact, I'm anticipating this to continue unless the earnings from the tech stocks are really, really good today, which I don't think they're going to be. There's going to be a lot of forward earnings pressures from the companies, like Zscaler. Here, let me show you what I was just example here. Plunged over 6%. They reported upbeat results, but revenue guidance declined to lift its full-year billing forecast. Forward-looking statements are negative. So that's the big problem with tech. They're coming out with good numbers, but the future doesn't look as rosy. So it looks like we're moving back into healthcare, real estate, consumer staples, basic materials. That's the stocks that have been leading. And again, also, these are blue chip stocks. And what do I always tell you? At the end of the year, blue chip stocks tend to be bought because, why? Think about it for a minute. Hedge funds, institutions, they want to hold the safest stocks into year end. They don't want to do a lot of trading. They want to have as much capital under management so they can get bonuses. And it's much easier to get bonuses when you're holding Dow stocks that are moving very little and going straight up. They want safety at the end of the year. So watch the bond market very closely. Watch the relationship between the S&P, the Nasdaq, and the Dow, and watch these sectors very carefully to see which sectors are moving higher or not. And you're going to see a very clear, pattern develop over the next month. Don't miss the VIP room today. I'll talk about stops, where to put your stops, some stocks that I'm looking at, and there's some short stocks that are starting to come on my radar. And I've been waiting for that. We've had only longs. So it's time to start looking at shorts. So what sector's the strongest? What sector's the weakest? Healthcare and real estate are the strongest right now. And the weakest sectors, believe it or not, are starting to become energy and semiconductor over the last 5 days. Now, what about the last 3 weeks? Well, semiconductors and technology are still the strongest. Consumer staples, utilities, energy are the weakest. So there's an influx here. So you know what I would do? Here's what I would do. I would personally, if I was you, I would be very, very, very careful with sectors that have been going up nonstop. And personally right now, I would focus a lot more on the blue chip sectors than I would on tech. So what do I like? I like real estate right now. I like basic materials right now. I like utilities. Where's utilities? I just had it here a minute ago. Look at utilities. Really like utilities. So my focus would be focusing on blue chip sectors and fading the speculative tech sectors for the time being. Now, Monday, we had a big reveal on Monday. We had the infinite loop with Casey and myself. It was incredible. Folks were dying to know how an automated trading robot could target 15 to 25% in extra cash flow a month. And You literally need to start with $100. There's not a big entry ticket to get into all of this. Not to mention you barely need to lift a finger. So we're going live today at 1 p.m. We're going to answer a lot of questions that we didn't get to answer yesterday. I heard Casey went about an hour after I left. I didn't even know. I thought we were done. So it's going to be a very cool special encore. You'll also get a preview of the biggest trade Casey's looking at right now. So click the link below and join us for the 1 p.m. It's very cool. It's very different. There's no correlation with stocks. You need a very little account, and it's very cool, something on the side. I love it. Follow the link below. Check it out, and I'll see you later. Make sure, subscribe to my Telegram channel, subscribe to my YouTube channel, and join me in my VIP room.